Okay, so when you ratify a contract on your house or submit an application for refinance, you are then ready to pick yourself an interest rate, lock it in. You do that by taking this thing called a rate sheet that you get to pick a rate from. You get to customize your rate. Okay, you don't have to take the standard rate that you're given. You can usually go lower on the rate or higher on the rate. But then to offset that, there will be extra or less closing costs for it. So here's an example. This rate sheet is for a jumbo loan. You will see left-hand corner is the rate given, the different rates you can pick from. The middle is your principal interest. There's no mortgage insurance on this, so this other thing is blank. And then on the price column is really irrelevant. Don't worry about that. But then on the far right-hand corner, you see the credit/cost column. This will tell you how much you get back at closing or how much extra you have to pay to get that rate. And if you get anything back, then it's going to give you a negative value there. So the higher rates towards the bottom give you a negative or closing cost credit amount there in the parentheses. For this one, these jumbo loans usually have some decent trade-offs going up and down. You get like half a point of the loan amount in this example increase or decrease in your closing costs or closing credit. All right, so see the base rate. The base rate here is 5.375. It means it's closest to zero flat in credits or costs. And right here it's not zero, but it's 0.125. So you would have to actually pay 0.125 points of the loan amount or $937 extra in closing costs to receive that 5.375 rate. You can then calculate your trade-offs or break-even dates with this thing. So for example, if you didn't want that base rate, that 5.375, you could spend $37.50 more on closing day to get the rate right above it, the 5.25%. So then instead of paying $937 in extra closing costs past the standard amount of closing costs, you would then pay $46.87. And that would decrease your payment by, you see in the middle, principal interest, $41.99 minus $41.41 is $58 of a decrease. So to find the break-even date or trade-off of this, you would divide that extra you're paying in closing costs, that $37.50, by the savings, $58 a month, and then you would get 65 months. So you would then have to be in that loan for 65 months for that trade-off to have it make sense. If you're not in the loan for that long, then that really wasn't worth it, and you shouldn't have done that buy down. So I'll give you another example here, a VA loan. You see the base rate is 6.5%, zero flat credit or closing costs on the right there. Then look at just going up the rate scale on this. To go up the rate, go all the way 0.5% up to 6% flat of a rate, it costs you $4,600 to do that. And that reduced your payment by, what is that? $99. Whereas if you did the opposite, if you increased your rate by 0.5%, you went from 6.5% to 7%, you would get back $2,300, $2,301 in closing cost credit. So that then increased your payment by, what is that? $102. So you would literally be getting half of the amount of credit to go from half of the amount of money in a credit to go from 6.5% to 7%, as it would be to go from 6.5% to 6% there, which is the same distance that it would be from one rate to the other. It would just cost you a lot more to pay it down than you would get credit back to take a higher rate in that case. So I wanted to show you that because sometimes the buy downs make sense, sometimes they don't. They're different for every type of loan and scenario. You just never know. But you would have more of an incentive to pay more closing costs if you're sure that you're going to stay in the house in the loan for a very long time. Because a lot of those break-even dates, like that one example was 65 months. Some of them take 4 years, 5 years, 6 years, 7 years. sometimes even more. So you calculate that and, just give yourself an idea of also then how long you think you'll be in the house. But you also have to be comfortable fronting all that extra closing costs on closing day if you do want to pay more in closing cost credit to reduce your rate. But then you would want to take more credit if you thought you were going to spend less time in the mortgage or in the home, or you would have more of an incentive to take credit and increase your rate. But usually those don't make that much sense. Like I showed you with this VA one, you usually don't get that much credit to increase the rate as compared to how much closing costs you have to pay down to decrease the rate. But usually it's best to stay close in. You just don't know how long you'll be in that home for, and it's kind of a safe bet. But guys, I hope that made sense. If you have any more questions about that, leave them in the comments section, and I hope you stay around for the next video.